Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, consulting for HYCM. I do hope everybody is okay. I'm looking forward to taking us through this session. We are now in the Federal Reserve's blackout period. So for those of you who are unaware of that, that's the time when the Fed speakers are silent ahead of the next interest rate decision that's coming from the Federal Reserve early February. So before we get sort of stuck into the different topics, don't forget, as we look at different entries, exits, the whole idea and different instruments, the whole idea of this webinar is that we're looking at upcoming economic events. It's not a signal trading service and it's not a solicitation to trade. It's simply looking over my shoulder, seeing how someone with a professional trading background goes about making trading decisions. Those of you who are regular know exactly how this works. Good to see you, Alejandro, Gavin, Johan, Max, Nahar, good to have some familiar faces. And just as other folks are signing in, we'll start looking what we're going to be investigating coming up for this week. Now, we'll have a quick look at the Japanese yen after the Bank of Japan hold last week. That's going to be interesting just to see where we think they're going to move. A lot of pressure on the Bank of Japan, and they are really sort of holding out on keeping their ultra loose monetary policy. And they're trying to hold that line, so we'll just run over that and just make sure we're on top of the narrative there. Gold, the narrative remains tilted to the upside for precious metals, so that's why I'm expecting dip buyers this week. We may have a look at that during the course of the session. Earnings, big week for earnings and a big week for deciding the narrative of the Fed, not the Fed, whether the US goes into a hard landing, a soft landing. Is there a US recession coming? Will the US avoid it? And earnings will be scrutinized to test that narrative. Bank of Canada interest rate decision, that's going to be an interesting one. Could see some volatility for that. So that is a trading workshop topic that we will be looking at on Wednesday. So we'll keep an eye on that. Inflation data out of the US. Not as important as it has been inflation data because inflation data keeps falling. But if we saw a surprise spike higher in the PCE print later this week, that could give us some opportunities in the dollar. So definitely worth looking at. And some inflation data out for the RBNZ, and the inflation data it doesn't come out that often for New Zealand. So when it does come out, it's worth keeping an eye on it. And just reminding ourselves of the big narrative concerning US stocks and whether it's too early to buy. So we'll just run through the major narrative there. Okay, so first off is with the Fed's blackout period. Just to run over that with you, if you look here from January the 21st through to the Fed decision, which is coming on the 1st of February, we are now in the blackout period. So this is a period when we're not expecting any published comments from the Federal Reserve. And we'll just quickly look what expectations are for the Federal Reserve. But essentially, markets are expecting a 25 basis point rate hike now. Now, just because the Fed can't speak, it doesn't mean that you can't get a sneaky communication coming out. There is a Wall Street journalist called Tim Rayos who is cited as a Fed whisperer. In other words, he is looked at as an unofficial mouthpiece for the Fed during this blackout period. He has spoken before, and investors will be watching very carefully to see if Tim Rayos has any surprise announcements, any response to the earnings week that we have. We will be looking to see Tim Rayos says. If he says something, expect the market to react to it. So watch out for his narrative. Big names earnings coming out. We got Tesla, Microsoft, Apple all being released this week. And remember the uneven weighting of some of these big names. So Apple stock has a disproportionate weighting in the S&P 500. So that's why some of these big name earnings can disproportionately impact the wider stock market. So big surprises here. Tech stock, obviously very sensitive to high interest rates, and tech stocks have been sort of heavily sold off since the expectations of a slower US economic slowdown. If you just take a look, if we just had a little look here at, let's just have a little look at Tesla, for instance, you can see that Tesla stock fallen very heavily, over 60% from the highs in 2021. If you just go back here, yeah, you can see sort of 70% falls, 60-70% falls roughly since 2021, and that is a significant fall that we've seen. So the potential for surprising to the upside is going to be quite high. So just watch out for that. Tesla stock has had some disproportionate gains, and the seasonals are disproportionately strong for Tesla. 1 year over the sort of, the sort of 10-month, the sort of 10-20-day period over earnings had over 60% gain. So there can be some real volatility in Tesla, and investors are going to be looking at things like, yes, has the price cut really boosted demand for Tesla cars? How's shareholders feeling about Elon Musk and him also taking on Twitter? What's the electric vehicle competition like? How many deliveries have Tesla made? What's the outlook, etc., etc.? So expect that to be pretty, pretty hot for this coming week. Let's just see, where are we at? There we go. So in terms of the just checking the chat box and Christian box. Yeah, hi Gavin. Yeah. Now just take a look here. I'm going to zone us into what's happening. This is the big narrative. So at the moment, we can see that short-term interest rate markets, they're expecting the Fed to hike to 5%. They're currently at 4.37, and then to cut twice this year. That's the expectation. That's why we've been seeing the dollar being offered as we've started the year. Now, if you just take a look here, you can see that short-term interest rate markets are basically pricing in a near 100% chance of a 25 basis point rate hike. So that's what investors are expecting, 25 basis points on the 1st of February meeting on the Wednesday. And that's why we're seeing stir markets quite happily to project 2 rate cuts from the summer of this year. Now, the question is that view correct? So whether the market looks at the market's going to look at the next Fed decision very, very acutely. And if you remember that in the December rate decision, the Federal Reserve said there was going to be no rate cuts all through this year. So if we just take a look here at the HYCM Lab blog, this is a blog that I update very regularly, and almost all the material on this blog is my own material. So if you ever want to check something out, just check out the blog, and particularly the central bank tab can be very helpful. So I'll see if I've got the dot plot here. Yeah, so that was the dot plot from last December. So what this means is that Fed members saw the median rate for 2023 at 5.1%. So in other words, they didn't see any rate cuts till 2024. But the Federal Reserve, the stir markets are seeing 2 rate cuts this year. So that's what's going on. So investors are going to be looking at these earnings to decide, well, who's right? Is the Fed right? And there's going to need to be more rate hikes. They'll be looking at inflation data and the earnings. Or is short-term interest rate markets, there's going to be 2 rate cuts that are needed. So if we start seeing slowing earnings, that's going to help the narrative that the Fed will be able to cut interest rates twice. And as long as we also see slowing inflation, we don't want to see inflation stickier. We don't want to see that PCE print very high, because that will force the Fed to need to think about hiking interest rates, maybe holding them for longer, even if they don't go higher. So at the moment, the base case is that the US is going to head into a recession, and short-term interest rate markets see 2 rate cuts at the end of this year as the US heads into a recession. So that's kind of what's expected at the moment. And we can see that in the S&P 500, we've had this steady downtrend. That was the last Fed decision in December. And when the stock market saw, the Fed saying no rate cuts until all of 2023, stocks sold off sharply, as you'd expect, because higher interest rates means worse conditions for companies, and that's why stocks fell. We're now back up around this crucial level as investors are trying to work out, well, who's right? Is it short-term interest rate markets are right, and the Fed's going to cut twice this year? That's bullish for stocks. Or is the Fed right? There'll be no rate cuts this year, and that's bearish for stocks. We're around this kind of key trend line. Wouldn't be a surprise to see prices just move back up to this kind of 440.50 region ahead of February the 1st, or even lower down to that 3860 region. Markets are just waiting to find a key direction, and they're waiting to see what the Fed say. The reopening narrative continues to help China 50, and China 50 just making fresh highs now on the futures market. So, China's stock markets are closed for the China Lunar New Year, but futures markets still trading happily higher as investors are really happy on that reopening theme. That's also helping the commodity markets higher, particularly WTI crude, really benefiting from upside. And there is tightness expected in the oil market, so there is a bullish outlook for WTI crude swashing around markets, particularly on the China reopening theme, that when China comes back from the China Lunar New Year, expectations are that oil demand is going to really ramp up. IEA reporting that they're expecting China to boost that demand as we head into the first half of 2023 proper. So watch out for potential upside in WTI oil. Precious metals finding support on the weaker dollar, and yields have been dropping a little bit lower, and inflation expectations. So broadly speaking, the environment is conducive for gold and silver upside. Any retracements back down to that 1870, 1860 area remains suitable areas for going long on gold. So if we've got a deep drop down there to the 1860, 1870 region, that remains suitable with the current market condition. And any moves up to that 19,2000 region would be obvious profit taking zones. So just watch out for gold. Could see a little bit of a pullback this week. Similarly with silver, it's a little bit of an undecided area technically. We sort of had this false break of a Harami inside bar last week, which should be hawkish, but we're just around this sort of key overhead resistance level. So we're pretty sticky over there. If we can break over that and break higher, then that becomes key support, and then you can potentially look for around to that 2615, 2650 region overhead resistance in silver. Yeah, it's the reopening theme really helping the oil markets from China. Bonds just finding a little bit of sell-off in the bond market. That's just pushing yields higher. There wasn't particularly anything going on, maybe slightly hawkish outlook from the ECB, just helping to find a bit of sell-off in bonds. The dollar remains pressured and offered on the session, and that's been helping the majors higher, pulling back a little bit now. Nothing particular to say. The only thing to mention about the dollar index, of course, is the major trend line that's been broken to the downside, and this major trend line break is a bearish development as long as prices remain below this key trend line here. So if we get back above there, that's a more bullish outlook for the dollar. For now, below that level does keep the sellers in control. So that's mainly a bit of a technical battle, even though we are expecting the dollar to remain offered on those expectations we've looked at. That, yeah, yes, there's a Fed hike priced for the February 1st meeting. That's completely priced in now, and two market cuts are expected by the end of the year. So that's really a quick look around major markets and on what we're looking at. Yeah, okay. I'll have a look at that question at the end, Gavin, thank you, and yours, Ahmed. Thank you both for your questions. I'll look at them at the end. Let's have a look now at the major economic data points that we're expecting coming up. The ECB has had a slightly more hawkish outlook recently on expectations that the ECB is going to have to keep hiking interest rates. There was a bit of a wobble last week when it seemed to be suggesting that instead of being there 50 rate hikes, there was a little bit of a wobble from a sources report that was expecting the ECB to hike by only 25 basis points in March. That's been unwound again, and the more hawkish outlook is the dominant narrative, and that's just helping bonds to sell off at the moment. Nothing much really here on Monday. Obviously, you've got earnings in the background, so earnings will be carefully scrutinized. PMI prints on Tuesday, that can be important. Not expecting this to be tradable. We know the outlook is pretty dire for the Eurozone. The best opportunity here would come from surprise data points to the upside. The Eurozone is, debated about whether it will fall into recession or not, and expectations are that it will. But if this can, really surprise markets higher, and we see a good PMI print coming in above high market expectations, that could lift the euro a little bit further. If it's bad data, a lot of that bad news is already priced in, so not expecting that to have much impact. Similarly with the UK PMI print, a lot of bad news priced in for the UK. So the best opportunity would come from a surprisingly good print. Anything that's coming in very high, above 50 expansionary territory for the composite, the manufacturing level, and the services. If it's above 52, above 48, above 50 for and then above above 50 for the composite, I want to see on green aggregate beat, potentially get a little bit of upside in the pound US dollar. Just intraday stuff, nothing particularly to write home about there. US PMI data could be more interesting. Now, this is for January's data, and the base case is expected that the US is going to fall into a recession. It's about sort of 70–75% chance. So if we have any kind of surprise print to the upside, that's going to be pushing away from the narrative of the US falling into a recession and the soft landing. So I'd expect that to be positive for US stocks. So if we got anything above 48 for the services, anything above PMI for the global manufacturing print, anything above 47, then I'd expect that to be positive for US stocks. But you have to read it in line with what's going on with earnings. So we've got IBM coming up later on, and we've got Microsoft tomorrow. But if we saw a good print to the upside, we could see some short-term upside in the S&P 500. But it would need a surprise beat, and then you just have to watch that IBM's data doesn't change it, so change the outlook. So watch out for the IBM after the close. So in terms of intraday stuff, you've got Microsoft coming in tomorrow, which is when that CPI print is. Johnson & Johnson, American Express, 3M before the open. So you got to make sure, as long as the IBM earnings is okay, and if Johnson & Johnson, American Express, 3M is reasonably okay, then remember that you've got Microsoft coming after the close. So you might have a little window here of a little bit of S&P 500 upside, as long as you get an on aggregate beat, all those elements slightly higher. New Zealand inflation rate. So the headline expected to fall to 7.1%, and the quarter-on-quarter expected to fall to 1.3%. Anything that's very firm, coming in above market's maximum expectations, will increase expectations of a more hawkish RBNZ and should be bullish for the New Zealand dollar, but also look at the overall risk tone. So what are investors thinking about China? How's China's reopening doing? Is the markets risk on or risk off? That also impacts the New Zealand dollar. So just think about that, but potentially could get some opportunities there. Australian inflation data, not expecting that to have much of an impact unless we get a big surprise. If we just take a look at short-term interest rate markets, let's have a look. The RBA, you can see that the current expectations are that there's going to be a 15 basis point hike is the predominant expectation for 7th of February meeting. And that's fallen a little bit lower, you see. So over the last week. So what we're looking for here is if there's a big surprise to the upside in inflation, then that's going to increase expectations on more aggressive RBA, and potentially you could get an Aussie New Zealand dollar upside. So the thing to look for is if this is a big surprise to the downside for New Zealand and this is a big surprise to the upside, then potentially look for some Aussie New Zealand dollar repricing in the divergence between the RBA and the RBNZ. That's what I'll be looking for there. What's the New Zealand data like, and how does that relate to the RBA data? The interest rate decision has been very interesting for the Bank of Canada. The last meeting from the Bank of Canada saw the Governing Council say they'll be considering whether policy interest rates need to rise further to bring supply and demand back into balance and return inflation to targets. In other words, they were kind of hinting they could have been at the terminal interest rate. Now, if you just take a look at the expectations since then, expectations have increased since that meeting. Let me just show you here that the Bank of Canada, since December, are expected to now a 30% chance that they're going to be on hold, but a 70% they're going to hike by 25 basis points. Can you see the way the expectations for higher interest have just sort of edged higher since that December meeting? So what that means going into the Bank of Canada decision, that if the Bank of Canada only keep interest rates on hold, that should be increasing expectations of some CAD weakness. Now, the PPI print last week did move nicely lower, and raw materials dropped to 7.5% from 13% expected. So inflationary pressures are broadly falling, but the jobs data was pretty strong in December, with unemployment falling to like 5%, and there was a big boost of full-time workers. So yes, on balance, a 25 basis point hike does seem reasonable, but if there's no rate change at all, then watch out for immediate CAD weakness. So potentially you could look at US dollar CAD upside or any other currency that's strong on Wednesday. So just watch out for that. CAD weakness will be expected if there's no rate change. But if they hike, and then they say, that's it, we're done, we're not expecting any more hikes, that would also potentially see some CAD weakness. But the best opportunity would come from no interest rate
just looks like some comments.
decision. So do watch out with that. If it's just unclear, vague forward guidance, it's much harder to call the CAD's direction. The best opportunity would come from a no interest rate hike change, nothing. If they keep it at 4.25%, there is a little bit of opportunity there for some CAD weakness out of the event. Look for CAD with strong data point, and then don't forget you've got Governor Macklem and Governor Rogers speaking later. So then don't forget you've got the decision, but then you've also got the Bank of Canada governor speaking, so watch out for that. On Thursday afternoon UK time, we've got the important inflation data out for the US, and inflation data has continued to fall for the US. We've had headline inflation, core inflation falling, and now we're also expecting core PCE data to be falling. The forecast is 4%. That's down from prior of 4.7%. The price is expected to fall to 3.1%, down from 4.3%. So what we're looking for here, probably the best opportunity would be on a big beat. So if we had that core data coming in above 4.5, but ideally above 4.7, that keeps the pressure on the Fed. So you'd like to see some dollar upside. So euro US dollar short intraday opportunity is what I'd be looking for if we saw a big beat on that data, and or as S&P 500 short. If the data comes in very low, sub 3.2, we may see some more downside in the dollar, and that's potentially euro US dollar upside, and potentially a bit of S&P 500 upside, depending on what's happening with earnings on Thursday. Obviously, you've got Apple coming after the close, Visa as well, and we've got the aftermath of Tesla earnings the day before, and MasterCard coming before the open. So just got to bear that in mind. As long as the sentiment remains positive, there's a big beat below market's minimum expectations at 3.2, and then jobless claims is coming at the same time. So if jobless claims are also showing, a good, strong jobs market with less people claiming initial joblessness and less people claiming continued joblessness, all of that would be supportive for S&P 500. So I'll be looking out for that. Again, more data, PCE print coming up on Friday, exactly the same narrative. It's expected to fall down from the prior 5.5, headline core down from 4.7. So we're expecting a fall in PCE print. All of this should be dollar negative into this week, but best opportunity will come from a surprise to the upside. If it comes in above 4.5%, if the core is above 0.4%, then that's good. Don't forget Michigan inflation consumer sentiment print. This is the final print for January. We did see inflation expectations fell from 4.4 to 4% in the initial preliminary report. That was excellent for inflation. So we want to see that remaining low. If that drops even lower, that's even better. But just watch the 5-year. That rose from 2.9 to 3%. So if we could see the 5-year inflation expectations falling, that would have a real good impact. If we get both of these lower, then that supports equity upside, depending on what earnings have been like just this week. Generally speaking, most analysts favor longer term inflation expectations over shorter. So when there's a difference between the short and the longer term expectations, it makes for uncertainty. We want to see this 5-year inflation expectations falling down. If you look at the 5-year inflation expectations, let me just show you here. Go to the US. Let's look at prices, and let's see. You look at the 5-year expectations. You see how it's been relatively high. It stayed at this high level, 5-year inflation expectations. And if you compare that to the inflation rate for the US, you see the headline's been dropping, but the 5-year stayed pretty flat. So you can see why investors want to see the longer term inflation expectations fall as well. Okay, I'm going to get through to some of those questions now. Good afternoon, Ahmed. Would like to understand entry strategies. Yeah, so entry strategies, there's a lot that could be said for entry strategies, and there's different ways of entering. But whenever you enter, you always want to have an idea on where you're going to get out as well. So part of entry strategies also strangely involves exit strategies. So let's look at a recent trade that I took on the S&P 500. See, I was expecting a little bit of upside in the S&P 500 from this Friday, the 6th of January. Now, if you just go back on the 6th of January, what you'll see is there was some US data that came out that was very interesting. We had the average hourly earnings falling lower. We had the non-farm payrolls pretty strong. And then we had that, where was it? Let me just remind myself. Yeah, then we had a big miss in this ISM data point after a firm jobs number. So this big miss, you see how the non-manufacturing PMI below market's minimum expectations, business activity below market's minimum expectations. All of this told me, aha, this is a sign of a slowing US economy. So that means the Federal Reserve will be less likely to hike interest rates, so I'd expect upside in stocks. So I was waiting upside in stock. I could just very nicely limit my risk under that trend line. So I just entered of a break of that trend line, and with price moving higher, I just have my stops the other side of this structure. So very simple trend line break on the daily chart. If you go to the 4-hour chart, you would have seen that this was, you know, very simple structure. You got 1, 2 touches, 1, you know, arguably 2 touches there if you'd drawn that a little bit tighter. So you got a kind of a symmetrical triangle pattern. It's an obvious pattern. There was an obvious reason to go long stocks, and then just going with the breakout and just moving the, you know, just going with that move. So the entry was just a simple break of a trend line. Ahmed, do come back on Wednesday and I can look at some more potential entries with a specific trade outlook. But one of the simple ways is just a simple trend breakout. It's my favorite entry, without a shadow of a doubt. Just entering on a trend line break is what I most enjoy and what I find most beneficial. The other ways you can enter in, Ahmed, you can scale into a position. You can enter multiple positions at different levels. You can also scale out of positions, and you can enter in a number of different ways. You can use buy on stop orders. You can use buy limit orders. So one of the good things about the terminal and your platform is you could have a pending order to enter. If price moves down to that region, 3870, you could enter when price moves lower. You could also have the opportunity of buying on stop. So, you know, you could buy if price moves above that 4150 and be automatically taken in. And you can also enter at market. Generally speaking, pending orders tend to be better because you're just a little bit more objective about the level you're seeing at. But whenever you're entering, Ahmed, always think, well, where do I get out if I'm wrong? Okay, I always do that. Like for this trade here, where I'm wrong if price moves underneath that 3796 region, and I will get out. Regardless, even if I think the fundamental outlook's really good, then I'll come back and find another way. I'd rather take the loss than be stuck in a trade that's going against you. You don't know how long it's going to move. So that's some things, Ahmed. Yeah, many thanks. Gavin asks, would there be a long swing trade in Aussie or New Zealand dollar regarding the China reopening theme? Yeah, that's quite tricky, isn't it? So my expression of a China reopening theme has been long China 50, and I have been for some time. So I put all my eggs in that basket. Now, what about the Aussie and the New Zealand dollar? That is a little bit more tricky. Let's just see what the basket of the Aussie and the New Zealand dollar is for a long-term trade. Now, Gavin's absolutely right. You know, generally speaking, the Aussie and New Zealand dollar should gain on optimism over China's reopening. A lot of trade from Australia is done with China. So when China's booming, that also supports the Australian dollar. And if you just look here at iron ore prices, that's one of Australia's biggest exports. You can see that the Aussie dollar moves in line with iron ore. Iron ore also is a big export from Australia that Australia typically exports to China. China uses a lot of iron ore, so growth in China should also support the Australian dollar. And if you also look at the China 50, you'll see that China's 50 index, when that's going well, the China 50 is also, you know, tracking the Aussie quite well. So bullishness in the China 50, bullish in iron ore should help the Australian dollar. So I'd say, yeah, any drift drops lower in the Aussie, I would favor buying it. It's just a question of what you pair it against. Do you pair it against the dollar? As long as the outlook for the US remains 2 interest rate cuts at the end of this year, then you would expect the Aussie US dollar to keep gaining. Let's just have a look at the bond yield spread between the Australian 10-year and the US 10-year. Let's just see what that yield spread looks like. Often the yield spread is a good indication of what future prices are going to be doing. Here we go. Right. Yeah, okay. So at the moment, there's a bit of a divergence there between Aussie 10-year and US 10-year. So that wouldn't give me a lot of confidence to jump in on that. And a lot of that the dollar is sort of around that technical turning point. So that wouldn't give me the confidence there to jump in medium term. Let's look at the stir market projections for the RBA. Okay, so we're at 3.1, expected to peak about 3.5. So that could be a couple more hikes into September, very small hikes. No, yeah, so that's what that yield spread is sort of punishing that Aussie US dollar outlook, isn't it? It's not looking very attractive. Maybe a divergence between the RBA and the RBNZ might be best, depending on what the forward guidance is between the two. Medium term, yes, I'm expecting upside in copper. I'm expecting upside in China's 50. But exactly how to enter that and express that with the Aussie dollar, even though we're expecting Aussie strength, that's what I'm pausing on. So I think in answer to your question, Gavin, yes, a long swing trade in Aussie or New Zealand dollar regarding the China reopening theme is fine. I would favor dips, and then it's just making sure you've got a nice location and a nice currency to pair it with. I'm struggling to find an obvious currency to pair it with right now. Yes, if the dollar keeps drawing lower and we keep getting more optimism about, more aggressive rate cuts coming from the Fed, then yeah, Aussie US dollar upside makes sense to me. But the bond yield spread is a little bit of a concern with that not moving in the right direction. I'm sorry I can't be more helpful there, Gavin. I'll have a little think, and if I see a great, if I think about a great way for the Aussie dollar, I can always come back on Wednesday, for the longer term outlook. But I think it's probably my kind of expression of a China reopening theme was on the China 50, which I've been interested in from the end of last year. So I've sort of put my eggs in that basket. So that's probably why it's probably not why I'm not looking around, Gavin, if you know what I mean. No, it's good. It's a good thought. It's a good thought. And if I'll think some more on it as well. Okay, folks, thank you all very much. Don't forget, I am due to be back here on Wednesday, and we will be looking at the Bank of Canada interest rate decision. So take care, everyone, and have a really good week. Thanks, everyone, now. Yeah, cheers, Gavin. Thank you. Bye.